welcome to Macros with Mythilli, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, the deadline for exemptions from US sanctions against import of oil from Iran is over, and unlike in the past when exemptions were in place but limited imports were allowed, crude oil imports from Iran will have to stop completely. What does this mean for global oil markets, the 8 countries that were exempted from the sanctions by the US, especially India? To discuss the ramifications of what could be a make or break development for us in India, I have with me a panel of experts to give you a 360-degree view of the possible consequences. Let me welcome to the show Augustine Peter, who as former DG of the PPAC, Petroleum Planning and Analysis Cell, has an in-depth understanding of the sector. Vandana Hari, founder and CEO, Vanda Insights, who will give us a global perspective, and Ashima Goel, noted economist and member of the Prime Minister's Economic Advisory Council, who will join the dots for us to tell us what all this means for the macroeconomy. So let me start by asking each of you in turn, how worried should we be? The possibility of sustained higher crude oil prices raises a number of macroeconomic concerns for us. In 2018, higher oil prices led to significant volatility in the foreign exchange market. The government had to finally lower the taxes on fuel products under political pressure, and this adversely impacted government finances, and inflation once again raised its ugly head. So how should we react to the unfolding scenario? Sanctions on Venezuela, disruptions in Libya, and controlled production by the OPEC countries. We'll go into the details a little later, but for now, the broad question of, on a scale of 1 to 10, how worried should we be? Let me start with you, Peter.
Yeah, it's a complex scenario which we are facing, and you are asking me to rate on a scale of 1 to 10. I would say it depends, because the sanctions, we had a waiver for a period of 6 months, and that was ended yesterday. And the waiver was basically based on substantive reduction commitments. And we understand that Italy, Taiwan, and Greece, they have completely stopped. And South Korea and Japan, it appears that they also reconciled. In the case of China and Turkey, they say that they may not comply with, but we don't know. The case of India, I think government is set to take a decision, but at the same time, it appears that the petroleum sector in the country is well prepared to face this scenario.
Okay.
So even though Iran is accounting for 10% of our imports, but at the same time, over a period of last few months, government and the oil companies have made arrangements, especially with Saudi Arabia. There is an excess arrangement for 2 million metric tons with Mexico, with UAE. So with the result, I think we have made good arrangements, and the refineries are well prepared to take up the. So there, I don't find there is going to be a scenario.
Vandana, US production and stockpiles are at a record high. The global economy, meanwhile, is slowing, and winter with its increased demand for heating oil is still far away. So demand is likely to remain muted, even though crude oil prices did rise by over 30%, and we've seen a very brief softening. So how worried should we be? Peter did not wish to give a number, but how worried should we be? Vandana?
Hi, Mythilli. Thank you for having me on your show. My concern right now is that the prices that we are seeing, Brent sitting just above $70 a barrel, it's backed off quite a bit. It was almost about to touch 75 because of some of the developments with regard to Iran as well as Venezuela in recent days. My concern is that the oil market is probably not pricing in entirely all the supply risks that have stacked up. So Iran is definitely a big one. 1.3 to 1.4 million barrels per day of crude and condensates that could get wiped out of the market in the next few days. But we also have quite a worrying situation in Venezuela as well as Libya, major OPEC producers. We've had shutdown in Nigeria, and we've had a major outage in a pipeline from Russia that conveys nearly 1 million barrels per day of crude to Europe. So you're right if you say that, yes, US inventories have been rising. US crude stocks, the commercial inventories, are sitting at the highest levels since September 2017. And US production is also rising, yes. But I think there is a worry there as well that these stocks are in the US and they're not really connected with the rest of the world. So, are we looking at just a part of the world and reassuring ourselves that there are enough stocks? There may be enough stocks for American refiners, but are there enough for the rest of the world? I think that's a bigger question.
Ashima, would you agree? And on the same scale of 1 to 10, where do macroeconomic concerns figure? Ashima?
I would after last year's experience, I would tend to be a little optimistic, because last year there was really, prices had shot up, crossed 85. There were reports that they would reach 100. But in the event, there were various sorts of adjustments. One, of course, delaying the sanctions. But that gave time for markets to adjust. As Peter was saying, India has taken measures to find other sources. And in general, I think for taking a longer view for the petroleum market, there are a number of factors that are tending to keep prices down. As Vandana is saying, short term there could be problems, but whenever there is a sharp rise in prices, OPEC gets worried that they are undercutting, because there are alternative sources now, shale oil, etc., as well as a big move towards green energy. So we saw that last time Saudi increased its production and the US pressurized them to do so, and they obliged. So I do not think we will see prices rise very, very steeply, say beyond 75. And the second thing is that a range between 60 and 75 is actually the best range for both oil producing and consuming countries, because we get remittances when that way, and then it encourages a supply response in the longer term. So I would put the risks at about 4, not more than that.
Okay, that's very heartening. But Peter, over the past few years, India has been trying to diversify its supply sources. But despite the fact Iran still accounts for about 10% of our total imports, as you mentioned, given that the US-Iran animosity is not new, would you agree that despite having think tanks like PPAC, where you spent a number of years, we really failed to read the writing on the wall and develop alternate sources or reduce our dependence really on imported oil? Peter?
Reducing dependence on oil, I think there have been efforts ever since many decades, but ultimately the dependence is increasing. The basic issue is that India is an economy which is growing at 7+% growth, and we require energy, and our dependence on fossil fuels are always very high, 92%. So that is basically making it, and alternative source of energy, basically they are about 8 to 9%, around 8%. It is extremely difficult to all of a sudden make changes in that direction. So I think efforts are being made. Actually, the efforts being made are making us where we are. Otherwise, we would have just gone very much down.
Okay. Yeah. So we have tried, it just hasn't been enough. But Vandana, the next OPEC meeting is due only in June. How do you read the tea leaves? Will the agreement on output cut continue? Or can we hope that OPEC, and not just Saudi Arabia alone, can be counted as a swing producer, especially given Trump's repeated statements in favor of soft oil prices? Vandana?
I think with regard to the OPEC, non-OPEC dynamics, especially going into the June meeting, it's becoming very, very complex. So from the start of this year and even before, we have seen a sort of tension between Saudi Arabia and Russia, the two main leaders of the OPEC and non-OPEC blocs, whereby we've seen the Saudis taking a somewhat hawkish stand, wanting to be very careful not to ease the cuts too quickly, whereas Russia has been advocating a more moderate stance, a more dovish stance. So I think this, as a result of all these supply crimps that we are seeing now, this tension could come to a head in the upcoming meeting. I do feel, however, that the Saudi viewpoint and approach of continuing the current cuts into the second half of the year is likely to prevail. My feeling is that the Saudis will want to see first if just by putting a little more oil into the market while still remaining within their current ceiling solves the problem of the loss of the Iranian barrels. The Saudis have been cutting nearly 500,000 barrels per day more themselves than they need to. So, before they formally set aside the sanctions, I think that will probably be the last resort for the Saudis.
Very true, Vandana. But Ashima, higher oil prices impact the current account deficits, inflation, as well as the fiscal deficit, and all three are closely interlinked. But even so, which of the three would you be most worried about, and why?
I think we are seeing that the pass-through of oil price rise has reduced. That is one of the benefits of an inflation targeting regime. There's a somewhat lower impact on household inflation expectations. Then the fiscal deficit, again, when the oil prices crashed, they did not reduce taxes. So oil taxes are pretty high, and in a way that's good from the point of view of conservation and moving towards other sources of energy. So there is some room there. I think the most worrisome is really the current account deficit at present. We are seeing some improvement in GST revenues. They're expected to improve after the elections as more of the data used is factored in by states. So I think the fiscal situation is not that dire, but the current account would be the most impacted. But just to make a point on Peter's comment, that actually the World Bank report, India report this time shows that oil energy intensity in India has been going down since 2005. So there is some impact of higher taxes and attempts towards shifting to renewable energy. And that is one of the factors that makes oil prices less of a threat.
Peter, the Petroleum Ministry has been putting on a very brave front. It says that plans are in place to source additional supplies from other major oil producing nations, and further that oil refineries in India are fully prepared to meet the demand for petroleum products. But Iran is India's third largest supplier, meets a tenth of our demand. In this context, it's been suggested that faster opening up of the retail oil market to accelerate its integration with the larger retail industry rather than limit retailing only to oil companies and public sector oil companies will help. Can you tell us why this should help, Peter?
Retail marketing basically has been the confine of 3 oil marketing public sector companies. There are basically 62,000 plus outlets. Out of that, 55 to 56,000 outlets are under the control or owned or operated or under the control of Indian Oil Corporation Limited, BPCL, HPCL. And remaining almost 4,000-5,000 is with SR, which is now, and basically 1,400 or so with Reliance Industries. Why? The issue is why it is so. Basically, the problem was that the private sector was interested to come in a big way into this area. But at the same time, the predictability, there was no predictability regarding whether there will be subsidy will continue, whether it will come back. When they came in a big way, were trying in 2014, 13, 12. So that time subsidy of diesel became very high. With the result, they could not compete in the market, and the subsidy was available only to OMCs. And what the advantage of having retail outlets? Basically, if there is retail outlets, there is in the private sector, and there is competition. What happens? The procurement of oil in the international market, there may be some efficiency which can be shared, which can be reflected in the retail outlets. The processing, the refining, whatever efficiency they have, and the agency commission, they can negotiate better. So there can be a price which is lower than what is prevailing currently, and there will be competition. The benefits of competition I need not emphasize. So that is actually not available, basically because if the price of oil goes up, then the price of diesel may be very high, and there is a fear that government may again come back to the subsidy regime, which will not be available to the private companies. But this government fortunately has made it clear that that is not going to happen. But if the prices go up, international price of crude, was above $100 by chance, then there is a possibility. That's why I think that apprehension is in the mind of
Oh yes, policy certainty and competition, these are two very important aspects in any sector. But Vandana, you spoke about how demand is expected to be muted, but do you expect that to continue? Also, past efforts by Trump we have seen to force down prices have resulted in some initial price decline, but after that it's been followed by fresh price highs, sometimes within a matter of days. So do you expect that to happen this time around also? And given how volatile the oil market is, in fact I feel foolish even asking you this question, but what is your best guess of where oil prices will be in the remaining months? Because this number has serious implications for our macroeconomy. Vandana?
So first of all, brace for volatility. Absolutely. We have seen two major spikes and very quick cooling off of prices in the past 2 weeks. I would imagine this phenomenon to accelerate, to intensify in the coming months, because as I just outlined, we have Venezuela, Libya, Nigeria worries in addition to Iran. And then on top of that, you know, the world always needs a little bit of spare capacity cushion to accommodate unforeseen outages in countries that are, you know, normally stable suppliers. So Russia is one of them. In the past years, we have seen Canadian supplies, you know, North Sea supplies suddenly being sucked out of the market because of technical issues and so on. So that spare capacity cushion in the market is going to go down quite significantly, I imagine, as OPEC and non-OPEC make up, pump more to make up for the loss of Iranian barrels. As far as oil prices are concerned, I think, as you alluded to earlier, the demand question is a very important one as well. Now, the oil market so far, as well as OPEC, you know, as it plans for its production policy, is assuming that demand growth will be tepid this year. It will not be anywhere near as strong as what we saw in 2018. While for the most part, I would agree with that. Because, you know, there are, even if the US and China sign a trade deal, there are other economic headwinds elsewhere in the world. But I think here again, there is a risk. What if the Chinese growth momentum does pick up, you know, after the trade deal? And we've seen some of the recent macroeconomic data from China, as well as if you look at the Q1 data, even from Europe and US, has been quite encouraging. You know, it has beaten analyst expectations on the positive side. So what if demand growth is stronger than expected? You know, I think we could be heading into a very severe supply crunch, supply crisis situation even, where OPEC and non-OPEC are already striving to produce as much as they can, and there just isn't more spare capacity available for other unseen outages.
So would you like to hazard a guess, Vandana, for the number?
I would say, you know, 70 looks like quite a firm support level for Brent. Again, another factor that I'd like to throw into the mix for consideration is that the US also has the leverage with its strategic petroleum reserves. So I do believe that Trump will do everything he can, especially as we go into the summer driving demand season in the US, to keep a lid on prices at the pump. So, you know, I do not expect crude to sustainably spike into above 75 or into 80. But as I said, it will probably remain. I would expect it to remain around 70. But I do not rule out, or in fact, I would say, do brace for the occasional, or more than occasional, even frequent spikes into 75 and above.
Sure. Ashima, Vandana has given us a very comforting number, I would think. But add to that the fact that the Fed actually has signaled a more accommodative stance. So while the current account deficit could still be under pressure in India, financing should be relatively easy. So how much comfort should we draw from that?
Yes, there has been some improvement in the current account deficit. And I do not think if the Fed is easing, it is because there is a global slowdown, which will not reverse so quickly. So meanwhile, that will have a softening pressure on oil prices. And by the time, say, if global growth picks up, then the oil market will have responded. You know, to Vandana's point, I would say that there is excess capacity to the extent OPEC is doing production cuts. If prices begin to rise, they may be forced to, or they may decide to reverse those cuts. So and then shale oil can expand production very, very fast, and the US has reserves. And for India, the current account deficit really becomes under pressure, and even the fiscal situation, it becomes difficult for us to absorb if oil goes above $85. And I do not think in the current situation is going to go above that, because I think markets also learn. They saw last year that they had feared 100, and there were multiple sources of supply and prices came down. So there is a realization that there are multiple sources of supply now, and also that demand growth is expected to be slow.
Peter, one of the biggest risks that in fact you and both, Ashima and you both mentioned it, is the way the next government decides to deal with higher crude prices if and when that happens. Cutting taxes or reintroduction of subsidies to contain the retail fuel prices could significantly increase the macroeconomic risk. Has free market pricing now become part of our collective DNA, or do you see a possible reversal if prices should go higher? Peter?
I don't find a reversal, because it was the pass-through was effected after a lot of effort. It is extremely difficult once you slip on that to come back again to that. So I am sure that government will be very, very firm, whether this government or any government to come, the next government. Certainly they will not be willing, but at the same time, if it goes beyond, which is a very limited possibility which I find. At the same time, there is, see, internally also, because initially we were discussing about that, government itself is making other efforts to ensure the dependence on oil is come down. For example, the biofuel policy 2018, the 2009 policy has been updated with a lot of new incentives. The basic, then second generation, third generation type of efforts to bring in biofuels in a substantial way. So ultimately, I feel that their normal circumstances, government will not be reverting to the.
Ashima, let me ask you the same question that I asked Peter. Do you see a return to subsidies in case, say, oil prices go beyond, say, $100 a barrel? Does the fact that inflation is under control and the RBI does not expect inflation to go above 4% in the current financial year give the government more leeway not to go down the subsidy route? Also, does the potential inflation risk due to high oil prices raise the hurdle rates for rate cuts? Ashima, so two questions. Can the government stand firm, whichever government, and what will the RBI stance be?
Yes, I think that the market-determined prices have become quite well established in India, and the political class perhaps has realized that there's much less pressure on them if they can put the responsibility on the market. And I think the pressures to revive subsidies will only come if, as Peter said, oil prices reach $100 or something, and that is unlikely to happen in the current scenario. So I do not think we'll see a reversion to subsidies very quickly. And second, again, in an inflation targeting regime, there's some evidence that expectations are somewhat better anchored, that the pass-through of commodity shocks has fallen. Even last year there was some evidence, and I'm sure that this improves going forward. So I do not think oil prices below 85 will be a major threat for inflation or will raise RBI's inflation projections. Yeah.
Vandana, I'm going to give you the last word, and this is a somewhat futuristic question in many ways. What is your long-term prognosis for oil? Will it cease to have this kind of pivotal position in the commodity space as concerns about global warming grow and we see a greater shift to not just alternative sources of energy, but also increased use of electric vehicles? Vandana?
I think there are no two views on that. Oil is increasingly being viewed as a sunset industry. Even the oil majors, national oil companies the world over are developing strategies on, they're reinventing themselves, they're renaming themselves, they're going into, if you look at Shell is a perfect example, they're going into the so-called new energies, renewables. Sustainability overall has become the buzzword of this century, whether it's in oil or in petrochemicals or other downstream industries in the energy sector. So the question only is, when do we think global oil demand growth will start plateauing, or demand itself will start declining? So that period is generally placed in anywhere between 10 to 20 years from now. It's very difficult to see, to try and pinpoint a time between within that period. So as you mentioned, yes, EVs are taking off. Generally, things like ride sharing, more public transportation. We have more renewables into the power sector, and generally, countries are trying to reduce their energy dependency, the fossil fuel dependency. So all of these, however, they're all starting off from a small base. So sometimes the world gets excited about the double-digit growth rates that we see, like for instance in EVs in China or in renewables in several parts of the world. But then that misses the fact that it's from a very, very small base. So at least for the next 10 years, I would say safely, I don't see oil being unseated as the biggest supplier, a biggest source of energy for the world.
Well, the good takeaway from that is 10 years is not an eternity in the life of a nation. In the meanwhile, however, we will have to brace ourselves for bouts of volatility that could rock the boat. How severely it rocks the boat will depend on the strength of our macroeconomic fundamentals, and hence the need to fortify our fundamentals. But thank you so much, Ashima, Peter and Vandana, for joining me in the discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythilli. Till then, it's thank you and goodbye from all of us at ET Now.